Welcome back to another edition of The Explainer. Today, we're taking a really fascinating look into the world of Indian tax law. Now, specifically, we're drawing directly from the incredibly comprehensive Institute of Chartered Accountants of India, or ICII, study module to unpack one of the absolute most vital areas of both personal and corporate finance, and that is capital gains tax. You know, tax law can honestly feel like this dense, impenetrable forest of sections and subsections. It's overwhelming, but if we just track the journey of a single asset, from the literal moment you acquire it, to how you hold it, to the moment you eventually part ways with it, all these dense regulations suddenly become incredibly logical. It's like a giant puzzle coming together. So, by the end of this explainer, you're going to have a crystal clear, structured understanding of exactly how the government views your property.
Okay, let's dive right in. We'll be hitting 5 key stops today. First, defining a capital asset. Second, short versus long-term holding periods. Third, actually calculating your capital gains. Fourth, capital gains tax rates. And finally, those tricky special cases and conversions.
All right, Section 1, defining a capital asset. Basically, what actually counts.
So before the tax man can take a cut of anything, we have to know if the item you're holding is actually subject to the tax in the first place, right? We need to know if it's legally classified as a capital asset. Now, under Section 214 of the Income Tax Act, the definition starts out insanely wide. The ICAI source explicitly defines it as property of any kind held by an assessee, whether or not connected with his business or profession. I mean, that covers almost everything you own, from real estate to shares to unit-linked insurance policies, even investments made by foreign institutional investors. The government throws this massive net to capture as much as humanly possible, but because the rule is literally so broad, the law immediately has to carve out specific exceptions just to protect ordinary everyday commerce and living.
And here is where it gets really interesting. Look at how the law systematically strips away everyday items from that massive net we just talked about. First up, stock and trade is excluded. Think about it. If you're a real estate dealer, a plot of land is your inventory, right? It's your stock and trade. So it's taxed as business income, not a capital gain. But if you or I buy that exact same plot just as an investment, it is a capital asset. So it's not about the nature of the item itself. It's entirely about how you hold it. Second, personal effects are excluded. That means movable property held for your personal use, like your clothes, your living room furniture, your personal car, those are not capital assets. And finally, certain specified government gold bonds and rural agricultural land are completely exempt from this definition too.
But wait, how exactly does the taxman define rural? Well, our source provides this highly specific mathematical definition. Agricultural land is only exempt if it falls safely outside specific urban limits. Check this out. If a neighboring municipality has a population between 10,000 and 1 lakh, your land has to be more than 2 kilometers away, measured aerially, to be considered rural. If the city's population is up to 10 lakhs, your land needs to be more than 6 kilometers away. And for those massive urban centers with over 10 lakh people, your land must be strictly outside an 8-kilometer aerial radius. If it falls inside any of those zones, boom, it's an urban capital asset, and selling it will absolutely attract capital gains tax.
Moving right along to Section 2, short versus long-term holding periods. So once we've established that you are indeed holding a capital asset, the clock starts ticking. And how long you hold it directly dictates how harshly you're going to be taxed. The law categorizes assets into short-term and long-term based on strict timelines, and these timelines actually vary depending on the asset type. According to Sections 242A and 229A, a listed security, like a share on a recognized stock exchange, only needs to be held for more than 12 months to qualify as a long-term asset. Pretty quick, right? But for other assets, like unlisted shares or immovable property, say land or a building, you have to hold on to them for more than 24 months. For literally everything else that doesn't fall into those specific buckets, the magic number is 36 months. Crossing these time thresholds is absolutely crucial because long-term assets generally receive highly preferential tax treatment compared to short-term ones.
Section 3. Calculating your capital gains. Time for the actual formula.
Okay, so we've identified the asset, we've timed the holding period, now we enter Phase 3, the actual calculation under Section 48. This is the engine room of capital gains. It's where we figure out the final tax bill. And honestly, the computation pro forma is beautifully straightforward. Step 1, you start with the full value of consideration, which is just a fancy way of saying, what did you sell it for? Step 2, you deduct any expenditure incurred wholly and exclusively in connection with the transfer. Think brokerage fees or stamp duty. Step 3, you deduct your cost of acquisition, which is what you originally paid for it, plus any cost of improvement, which is money you spent upgrading it. Step 4 gives you the result, your final capital gain. And here's a fun fact. If it's a long-term asset, the law often lets you index those costs for inflation, which can dramatically lower your taxable gain. It's a huge benefit.
Let's look at a real-world example straight from the ICAI source to brilliantly illustrate the math in action. Meet Mr. C. He buys a residential house in July 2023 for 10 lakh rupees. A month later, he drops 2 lakhs, improving it. So his total cost base is 12 lakhs. Fast forward to April 2025, and he sells it for 20 lakh rupees. If we follow our Section 48 steps, 20 lakhs minus the 12 lakhs in costs leaves a clean profit of 8 lakh rupees. But notice the dates here, July 2023 to April 2025, that is less than 24 months. Because he sold it so quickly, it is firmly a short-term capital asset. Even though he tried to buy another house to claim a tax exemption under Section 54, the source makes it abundantly clear that exemption is strictly for long-term assets. So, Mr. C owes tax on the full 8 lakh rupees. Ouch.
Section 4. Capital gains tax rates. The actual percentages.
So, Mr. C has an 8 lakh rupee gain. What percentage of that does the government actually take? This leads us to Phase 4, applying the specific capital gains tax rates to the profits we just calculated. And look, if you are patient, the government rewards you. Under Section 112A, the long-term capital gains rate for transferring listed equity shares where securities transaction tax has been paid is a very favorable 12.5%. Now keep in mind, this 12.5% rate applies only to the gains that exceed $1,25,000 in a given year. So holding on to those listed stocks for more than 12 months unlocks this highly concessional tax bracket. It's definitely worth the wait.
But if you get impatient and flip those exact same listed equity shares in less than 12 months, Section 111A kicks in. The short-term capital gains penalty bumps your tax rate up to a flat 20%. The logic here is incredibly clear, right? The government uses these contrasting percentages, 12.5% for long-term versus 20% for short-term, to actively encourage long-term investment over rapid short-term trading. They want your money staying put.
And finally, Section 5, Special Cases and Conversions.
Now, absolutely no discussion of tax law is complete without exploring the edge cases. The final leg of our assets journey involves looking at some highly unique scenarios where the standard rules get flipped completely on their head. Tax law is full of exceptions, particularly when it comes to converting an asset's fundamental nature. Let me ask you this. What happens when the lines blur? What happens if you take something you own personally and suddenly decide to inject it into a new business you're starting as stock and trade? Does that trigger a capital gain? Well, Section 45(2) deals directly with this, and the answer completely depends on what that initial asset was legally defined as.
Let's bring in Mr. A from another great illustration in the source material. Mr. A owns a personal car. He decides he wants to start a car dealership, so he transfers his personal car into the business as inventory and eventually sells it for a 1 lakh rupee profit. Now, you might be thinking he owes capital gains tax on that, right? But remember what we talked about earlier? A personal car is considered a personal effect, and personal effects are strictly excluded from the definition of a capital asset. Because the car was literally never a capital asset to begin with, converting it into stock and trade completely bypasses the capital gains tax net. Mr. A pays 0 capital gains tax. That is a brilliant little loophole.
But let's contrast Mr. A with our next illustration, Mr. X. Now, Mr. X holds a true capital asset bought way back in 2006 for just 60,000 rupees. In March 2025, he converts it into stock and trade for his business. At the exact moment of conversion, its fair market value is 5,50,000 rupees. A few months later, in June, the business sells it for 6,000 rupees. Here, the law steps in firmly. Because it was a true capital asset, the conversion itself is treated as a transfer. The government basically treats that 5,50,000 rupee fair market value as his sale price for capital gains purposes. Furthermore, the difference between the 5.5 lakh conversion value and the final 6 lakh sale price, that's taxed separately as business income. So both the capital gains and the business income become taxable in the year the stock is ultimately sold.
So the crucial point here is that not all assets follow that standard 12, 24, or 36-month timeline we mapped out. The source highlights a few strict carve-outs. For instance, under Section 58A, market-linked debentures and unlisted bonds completely bypass holding periods. They are always treated as short-term capital gains, no matter how many years you hold them. The exact same rule goes for depreciable business assets under Section 50. On the flip side,
If you sell an entire business undertaking as a slump sale under Section 50B, you simply look at whether you owned the whole business for more than 36 months to secure that long-term capital gains status. In these cases, the sheer nature of the asset totally overrides the standard calendar.
From figuring out if your property is legally a capital asset, to literally counting the months you've held it, to navigating conversions and special asset classes, the journey of an asset is undeniably complex, but it's incredibly structured once you see the big picture. Time, asset type, and the way you utilize your property fundamentally alter your tax liability. So as we wrap up this explainer based on the rigorous ICII modules, it leaves us with one really critical question to ponder. Have you looked closely at the exact legal classifications and holding periods of your own assets lately? Understanding these rules isn't just about compliance, it's the absolute bedrock of smart financial strategy. Thanks so much for joining me on The Explainer, and keep learning.